Every day, the world moves on as it always has. Cities wake up, work begins, and life feels familiar. But beneath that sense of normality, something is shifting. The climate is changing, and the systems we rely on, energy, food, water, cities, finance, are under pressure in ways we're only beginning to understand. These changes don't live in reports or projections, they are already shaping people, livelihoods, and communities. We created the Climate Leadership Podcast so these challenges don't remain abstract or distant, but are explored through the people working inside these systems, making real decisions with real consequences, often without clear answers. This is not a space for fear, blame, or perfection. It's a space for honest conversations about what leadership looks like in a changing world. If you're listening, you're already part of that leadership. Let's begin the conversation.
Welcome to another episode of the Climate Leadership Podcast, where we explore the systems, capital flows, and leadership decisions shaping real-world climate action. Today's episode focuses on one of the most critical but underexplored questions in climate finance: the role of private equity in emerging markets. These regions will define the future of climate outcomes, yet they continue to face significant gaps in capital infrastructure and risk appetite. I am joined today by Mr. Yalin Karadogan, partner at Leapfrog Investments, where he works at the intersection of private equity, fundraising, and climate impact investing. Yalin, it is great to have you with us.
Thank you, Amber, for having me, and thank you for this very valuable show you're putting on.
Thank you. So before we get started, may I request you to please share a bit about your professional journey so far?
Sure. So my journey started in Istanbul. So I actually come from an emerging market myself. I lived there until 1993 when I left to go to the US for my undergraduate education. Got my first job in New York City in investment banking, although in March of 1998, I moved over to the private equity team of JP Morgan Chase, the bank. And I stayed in that team for about 8.5, 9 years. They sent me to London, so I've been a Londoner since the year 2000. In 2006, I moved over to European buyout firm Cinven, where I spent the next just under 15 years. I did deals, sat on boards, made it to partner, so on and so forth. And then towards the end of my Cinven years, I transitioned from deal doing to fundraising. And maybe just to add a little bit there, I started to be obsessed with climate change as a topic, and I started to read everything I can read, watch everything I can watch. I also, in parallel, started to get involved with active philanthropy. So I'm a co-founder of a charity here in the UK called Turkey Mosaic Foundation, which is essentially a UK registered charity that does work in our homeland of Turkey. And environment is one of the themes, but also gender equality, children's rights, culture and arts, and generally supporting civil society. But as I was getting involved in philanthropy, and as I was talking to investors, raising funds, and as I was starting to be obsessed with climate, the light bulb moment happened. And when I left Cinven in 2021, I knew that my calling was impact investing, and particularly in climate sustainability. And impact investing, which is what I wanted to really do. In 2022, I joined Leapfrog as partner, and I've been at the firm since then. I've been involved with quite a few things at Leapfrog, all the sort of investment committees, executive committee, portfolio review committees, and so on and so forth. And at this point in time, I'm exclusively focused on the climate strategy of the firm. I'm very much talking to investors 24/7. I know you have a few questions about that, which we can chat about. I'm also sitting on the investment committee of the Leapfrog Climate Fund.
Okay, wonderful. Thank you for giving your time today, Yalin.
Thank you.
Okay, so to begin, when we talk about private equity solving climate challenges in emerging markets, what does that mean in practical terms beyond the narrative?
Sure. So I guess the first thing to point out is when you look at carbon emissions, when you think about climate investing, it's of course about mitigation and adaptation. When you think about the mitigation side, today, a larger chunk of the emissions, of course, for our planet are coming from the developed markets. However, when you look at the markets that Leapfrog operates in, which is South Asia, Southeast Asia, and Sub-Saharan Africa, when you look at the emerging consumers that live in these geographies, which is about 4 billion people, and the population growth, GDP growth, and the energy spend forecasts over the next couple of decades, you see that what's today a 75-25 split between developed markets and developing markets, in 2020 is the exact other way around. It's 75-25, but the other way around. So the developing markets today make up a bigger part of the emissions problem for our species going forward. So essentially, investing in private equity in emerging markets for climate is both to help with that, these emerging consumers as they grow, the carbon footprint that they develop being a sustainable carbon footprint, unlike what we established in our Western cities. And also, it's a massive investment opportunity given the significant energy transition that's underway.
Right. Okay, so emerging markets are central to climate outcomes, yet capital allocation remains limited. Where do you see the biggest disconnect today?
Yeah, so I think the investment opportunity is the one that we spend a lot of time talking to investors these days. This massive energy transition that's underway, that's happening in motorcycles or rooftops all across Asia and Africa. And it's happening and it's real, and it is fueled by new products that have been coming online, let's say, over the last couple of decades. However, investors are not allocating as much capital to emerging markets. And that's an allocation decision that takes quite some time to change. Some investors have really grasped it. Some investors in the US, in Europe, in Asia, in the Middle East as well, really understand the opportunity and are excited about it. And they have allocated a significant amount of capital. But the biggest disconnect is at the moment, there's a massive investment opportunity that we see in our pipeline and in the investments we make, and we're really, really excited about. But it's a smaller percentage of the allocations at the moment for the mainstream sort of private equity investors in the world. And that's a perceived risk sort of opinion on emerging markets at the end of the day. And some of it is based on historic track record of maybe other investments they may have made in emerging markets. But what we are seeing at the moment is that risk return profile is quite attractive in emerging markets at the moment in Asia and Africa. And we are very excited about that. And that's what we spend time talking to investors about day and night.
Right. So, yeah, Yalin, like you shared this equation, right, that there is a massive opportunity, but investors are still not buying into that. So what do you think are one or two reasons, according to you, why they are not yet buying into that?
Yeah. So I think, look, investors, to be fair, it would be significantly easier if climate investing was an established asset class for decades. So it would be significantly easier for an investor to look at a fund if it's a fund 5, and the private equity firm was founded by the same team that's investing funds 1, 2, 3, 4, and now is raising fund 5. Fund 1's been fully exited and fantastic returns. Fund 2 has been, fully exited, great returns. Fund 3 has some DPI, and Fund 4 is looking good, but it's an early fund, and now you're raising Fund 5. It would be nice to be able to look at that. The challenge we have, of course, is climate investing, impact investing, sustainability investing in private equity is still a relatively, new concept. The first, I think, people that use the impact investing phrase, Leapfrog is one of them, was about 20 years ago. And in private equity terms, where we measure success in decades, 20 years isn't that long. It's you can't squeeze too many funds into that kind of period. So there, and climate is still relatively new within that. So I think when you think about it takes time to build a track record, and it would be nice for investors to look at a track record. It's just not really available. Very few people are raising a fund 4 or fund 5. Most people are still raising a first fund or second fund or third fund. And that's one of the part of the disconnect at the moment.
Okay, I see. So we are still in the early days. We do need a decade or more to have those kind of perfect, to see the returns from the current investments, right?
Yes. On the other hand, of course, there is a sense of urgency in this problem in terms of emission reduction. So what, of course, most investors are doing when they support early stage or first time funds or second time funds, etc., is they look at not just the strategy and the pipeline of this team that's been assembled, but they need to really look at the track record of the individuals that have joined this firm
I see.
before. And if that track record is being reflected in the strategy of this new, it could be a first-time fund, but it could be a series of very experienced, knowledgeable investors with some great track records that have got together. And of course, when you're assessing that, you need to really think about their motivation in joining and so on and so forth. And if it all makes sense, a first-time fund, of course, makes a lot of sense for investors to back.
Okay, I understand. Okay. So from your experience, how does private equity uniquely positions itself to drive climate impact compared to venture capital or public markets?
Yeah, it's a great question. So one of the beauties about the private equity investment model is active ownership. So whether you're a growth equity firm or a buyout firm, so whether you buy 10% of the company or 30% or 90% of the business, you do have representatives on the board. And if you have 1 seat or 3 seats or whatever you have, you are significantly aligned. When you make an investment, you're significantly aligned with the management team on the strategy and the impact that you're looking to generate. In fact, a firm like Leapfrog and other impact firms as well, we would not make the investment if we didn't really see that the investment's going to be completely aligned with management team as well as our objectives. So as a result, by sitting on that board, we're able to really sort of help the agenda, dictate the agenda. If things go sideways, redirect the agenda. If we can improve any of the impact monitoring or reporting or depth and breadth of the impact, that's the kind of thing that we can actually do because we sit on the board. You cannot really do that as a public investor unless you're one of these really big funds with a big influence, one of these activist type investors. And I think this is where private equity has a really unique role to play in impact, in driving the impact agenda across the boardrooms of the world.
Right. Okay, so like you guys at Leapfrog, you sit at one of the tables of the company, and then you have investors who trust you to take the right decision.
Exactly. Our investors don't know which companies we're going to invest in when they invest in our funds. Okay. But when we do invest in, aligned with the strategy that we've told them, then of course, when we're sitting on the board of these companies, we're able to say, okay, here's the strategy that we'd like to pursue.
Yes, understood. Okay, so you have led fundraising across global markets. What are the biggest challenges in raising capital, specifically for climate-focused funds today?
Yeah, so the climate investing is complicated at the moment a little bit because one of the largest economies and one of the largest carbon emitters in the world has just, the US exiting the Paris Agreement, to put it very openly, is a big deal. And of course, that creates some confusion. Yeah. So at the end of the day, a lot of the push towards climate investing, is bottom up, top down. But at the end of the day, if your CEO or if your trustee or if your CIO, if your stakeholders, if your pensioners, if there is no pressure for you to continue to invest, of course, that's a challenge. If you're a sort of mid-level investment professional and for you to go out and say, well, I'm not being asked about this, but I still want to do this. It's a very tricky move at the end of the day. So I totally appreciate there's some confusion out there with the drill baby drill kind of guidance coming from all the way at the top. At the end of the day, however, decarbonization is only one of the big themes. So when you think about the sort of the macro themes these days, the way we think about challenges around climate investing, decarbonization might have some challenges around it on its own, because the same investor might be invested in fossil fuels and might find it difficult to step up and invest in decarbonization. However, there's a concept of the green discount, which is really, really important, that I just want to mention. The green discount is when the climate-friendly products have become cheaper than the fossil fuel burning alternatives. And we view this as the sort of the validation of decarbonization, or the second mega trend around this, because this is when you can actually see tens of millions of people switch to climate-friendly products, not because they care about the climate. They'll switch because there's a cheaper, better alternative out there. Yeah. And that itself is a very commercial sort of judgment opportunity for an investor to look at. So when you think of climate, you can say, okay, well, these are climate products, but at the end of the day, it's actually a product that's cheaper and better than what others have. And this is why it's going to grow very fast. Therefore, it might make sense as an investment. Yes. And Amber, maybe to add a third mega trend, which is a new one at the moment, which is of course energy security and energy food security, which is big. It's a bit sad how that's become more thematic over the last few months because of armed conflict in the Middle East. However, it is an important topic that many investors, many countries are actively thinking of in terms of the energy security, and that drives investments towards climate, renewable investments that are sitting in your rooftops and in your gardens and things like that. So decarbonization is only one, but there's also the green discount and energy security.
Right. So, Yalin, I was thinking, can you give me some examples of these products which use green discount?
Sure.
Yes.
Yeah, let me give you one. Let me give you one from India. So India is the single largest country Leapfrog invests in, and we invested in a company called Battery Smart. And I'll tell you what Battery Smart does. It's a brilliant, exciting business. So imagine you're a driver and you're a food delivery person, and you work in Delhi, and you have your phone, and you're starting your day, and you're going to do a bunch of pickups and drop-offs all day. If you were to do this in an electric motorcycle, and what Battery Smart allows you to do, it's a battery swapping network around India. So imagine you're a driver, you sit on your motorcycle, you haven't bought the battery, you've rented the battery. The battery itself is about 40% of the cost of the motorcycle in some cases. So first of all, you've saved a significant amount of capex, and you've bought something that's cheaper than any other type of motorcycle you can buy. So you're driving, you've rented the battery. About midday, you've done a bunch of pickups and drop-offs. The phone will say, take the next right and swap your battery in the station. The app is optimized. It'll tell you where to go to avoid a queue, and when your battery is sort of starting to drain, and so on and so forth. You go there, take out the battery, put the new one, QR code, one person working at the station, and in 2 minutes, you're back on the road. Sure. I timed this during our due diligence. It is 2 minutes. If they include a bit of chatting time, of course, that could be a bit longer. But then the driver is back on the road in 2 minutes. It's faster than filling the tank if you had a diesel sort of motorcycle. And also you're able to do more drop-offs and pickups because you haven't spent the sort of 5 hours or 7 hours or however many it might be to charge the battery yourself. The batteries are being charged in the station, and there's always available batteries when you go to that station. And then you're back on the road. And the punchline of all of that, Amber, is the driver gets to save over a, let's say 5-year, ownership usage period. You get to save about 40 to 45% potentially in terms of your costs. Okay. So that's the green discount at work. You have zero tailpipe emissions. So it's fantastic, if you walked around in Delhi, you'll appreciate what I'm talking about in terms of air quality and, of course, all the healthcare benefits, all those things later on. But when you think about the tailpipe emission reduction, it's great. And also you get to save money. And when a product has got to this green discount, that's when you can really see, tens of millions of people adapt to it. And that's the exciting thing for Leapfrog is to scale these proven technologies. We're not looking to invent a new battery, but once a business model has come up that can profitably scale this technology, then we'd love to play a role in scaling that. And it looks like the business is doing really well since we invested.
Right. Okay. Yeah, that sounds good. I'm from Delhi, so I understand.
Yeah, you know exactly what I'm talking about. Yeah.
Yes. It's very important right now.
Exactly.
Okay, so what are institutional investors really looking for when they commit capital to climate strategies, and where do most funds fall short?
I think we chatted about this a little bit. It's really the sort of that track record of having seen prior funds, because the industry is still relatively new. But as we just mentioned earlier, I think at the end of the day, there is a track record, there's a pipeline, and institutional investors really need to look into who's investing this fund, what are their motivations, what is this firm's motivation in getting into climate investing. It might be a first time or second time fund, so not ideal from a long-term track record perspective, but this is the kind of assessment that an institutional investor can go through and still make some interesting investments out there. Sure. And there are some firms that have been doing it for quite some time. So I think there are some new entrants and some longer entrants. There's venture capital, growth equity, buyout, infrastructure. There's lots of different ways that to be able to approach climate investing.
Right. Okay. So sitting on the investment committee, how do you evaluate whether a climate deal in an emerging market is truly investable?
Sure. I'll tell you the framework we have at Leapfrog. I'll open up a little bit. We have a 3 C's framework. The 3 C's are, firstly, it's climate. So the company needs to have a demonstrable opportunity to generate climate impact, whether it's mitigation, which is greenhouse gas emission reductions, or it's adaptation. We need to really get convinced that the sort of climate impact is going to be there. The second C is company, and that's the usual, assessing a normal sort of business or mainstream business. Is this the right company? Is it the right management team? Does it have the right products? Does it have the right margins, right competitive edge? What are its unique selling points, and all those kind of things, the right customers, the right contracts, and so on and so forth. And finally, it's the construct. The third C is construct. And what we mean by that is the deal construct. And that's primarily, valuation. It's primarily things like, are we sitting in the right place in the capital structure? Do we have the right sort of downside protection mechanisms and the right board representation, and so on and so forth. And we look for all three of those C's in every investment we evaluate in the investment committee.
Okay, I understand. So I was just thinking, Yellen, like you mentioned, like your Leapfrog, there must be other investment companies as well. So what is the probability of getting things right, like in this market?
You mean at the investment committee level, or at the ultimately with the investment in,
Yeah, at the investment level, like you are generating returns, or there was some problem and you can't generate returns. So
well, it's difficult to put a number on it, of course. You'd have to look at lots of companies and lots of funds to look at sort of track record of individuals and firms and things like that. But at the end of the day, when you go back to the three C's, if partly that's part of the question, usually the climate C, the first C, it does not tend to create a problem, because obviously the investment professionals are driven, with climate investing mindsets, and therefore they don't even tend to bring stuff to investment committee if they're not really convinced on the climate impact potential. The company side, of course, is where things might go wrong. You may have thought that the product is this, but the product is really that, if you see what I mean. Or you may have thought the customers are very sticky, but turn out to not be the case. And often one of the truisms in private equity, of course, is, you might like a company at this price. You might really like it at this price. You might love it at that price, at that valuation. So one of the things that a lot of private equity firms do is they make investments in what could be a perfectly impactful company, in what could be a perfectly good sort of business, but just overpay. And as a result, it's not a good investment. And usually that's where the problems arise, is when the sort of the pricing, the valuation of the business has not quite been done the right way because of some of the risks and other things that have been maybe not weighed appropriately in your assessment.
Right. Okay, I understand. There's a perception that impact investing comes at a cost of return. In your experience, is that trade-off real or misunderstood?
Yeah, I think it is misunderstood. So we don't view impact as a switch, right? Like Leapfrog's made an investment, or this impact investors come into this company. Now let's switch on the impact sort of lever, right? It's fundamentally tied to the company's value proposition at the end of the day. And it's both upside as well as downside protection. And essentially, if you're solving a problem for a big part of the population, whether it's a social impact or climate impact, and if what you're doing is therefore your core business is solving a problem and therefore generating impact, but also if you got the green discount at the right level, if you've got the right sort of growth strategy going forward, you will achieve significant amount of growth whilst you're generating impact. And the two things are not separable from each other. So we don't really view that as, even when we exit a company, the next buyer cannot say, okay, you know what, I'm just going to switch off the impact lever and make more profit. It doesn't quite work that way, because the value creation is actually the impact at the end of the day. And they wouldn't be excited to buy the company from Leapfrog if they didn't get excited about the growth potential and therefore the impact potential.
Makes sense.
And I think the growth, the green discount is still a very good example of that. Because when you have a product that's cheaper and better, it does scale very fast.
Yes.
And that's where we come in to really scale it. And then, maybe when we exit, the next buyer can make the company, a public business, or, it could be a strategic exit, or whatever it might be at that point in time. But the journey continues.
Right. That makes sense. So how do you manage risk like policy uncertainty, currency volatility, and execution challenges while still delivering strong returns?
Yes, all of the above. Look, I think emerging markets are volatile. And I think, one of the things that we look to do, for instance, currency is a big volatility point that investors always bring up, and rightly so. But we have very clear views around that. and in terms of how we construct the portfolio. So I guess the first thing to say is, and this is not just for Leapfrog, but for any sort of emerging market investor, diversification is really, really important. What I mean by that is geographic diversification as well as business diversification. So you're not putting all your eggs in one basket. Not everything is in. So in Leapfrog Climate Strategy, we have 4 subsectors. Energy, clean energy access is one, logistics and mobility another, food and ag, and then built environment, so waste recycling, etc. So first of all, it's 4 different sectors about how we go about our daily lives. So yes, it's called the climate strategy, but at the end of the day, this is how we build our cities, how we get around, how we access energy, how we grow our food. So first of all, you diversify by sector, and then secondly, you diversify by geography. Then when you think about it as a matrix basis, no single sector in no single geography can really bring your fund down. And we value that greatly. And as a result, you bake into your base cases some currency volatility, but then you add this geographic diversification, and then you've constructed a fund that has a healthy level of risk mitigation around this. The other thing we tend to do, which I know other investors do as well, is we do focus on some of these global type investments. What we mean global is it could be an Indian founder, Indian back office, Indian technology, but the business was founded in the US. It was funded in the US, and it's a US headquartered company. 25% of revenues are from the US, 75% from India. We would call that a sort of a global investment. And that's helpful for a US dollar fund to have some US dollar revenues in your portfolio. Because again, you're sort of mitigating that FX risk. And so on and so forth. And of course, we have lots of other strategies around matching your debt with your revenues and et cetera, et cetera. So one does need to have a lot of experience. If you don't know what you're doing in emerging markets, of course, it can be a tricky place. But it's not hugely different to a US buyout firm coming and doing deals in Europe, even if it's sort of both Western markets. You need to really know what you're doing. You need to really have a view on currencies and economies, really be in the flow. The Leapfrog team is on the ground, and all the investment professionals come from deal doing experience in the countries that they sit in. And obviously, that's incredibly valuable.
Right. So like currently, for example, Indian currency is depreciating a lot, like rupees falling against dollar. So, how do you see that or manage that? Is it a big risk or something?
Yeah, so look, I think all the currencies, specifically again at Leapfrog, all the currencies that we invest in, India actually, when you look at it over the last 5 years, it's been a remarkably stable currency. Actually, I haven't looked at the latest numbers, but versus the dollar, it may have been even more stable than the sterling, for instance, in the last 5 years. It's an interesting challenge. I'll let you look into later. But there have been periods when it's been significantly more stable, and of course, with some of the market volatility at this point in time, it's natural to see some volatility after a couple of years of very strong stability. And as long as you've modeled, assuming some depreciation, as long as you're growing significantly above, so if your companies are growing 40, 50, 60% year over year in local currency, and you shave off some of that in US dollar depreciation, 5, 10, 20%, even maybe, you can absolutely absorb that. Right. For a fund where you're looking to, do a sort of 20 to 25% gross returns. So the challenge is when a single currency gets like a massive deterioration, like a big currency shock, like a 25% depreciation, that kind of thing, which does happen sometimes. And if that happens during the period when you're holding assets, because we have 5-year investment periods, 5-year harvesting periods. And if you've done, let's say, 4 or 5 investments in that one country in your fund, then of course you could be in a tricky place. But that's why, again, back to the question of really knowing the countries, really understanding the risks, and building a portfolio accordingly comes in.
Okay, understood. So finally, looking ahead, what does or how does successful climate private equity over the next decade? How do you define that, and where do you see the biggest opportunities?
So I think at the end of the day, funds raising a second fund, a third fund, a fourth fund, successor funds is one of the clearest indications that a private equity is doing something well. So you look at a private equity firm, they're raising their first fund, and then they've raised a second and third and fourth, and wherever they are in that journey, if investors are supporting the strategy, it does look like they're delivering that sort of profit with purpose at the end of the day. And the way we will all judge success in emerging markets climate investing is, of course, we already look back today for the last 10 years, but in 10 years, we'll look back at the last 20 years, if you see what I mean, and then see how much capital we've been able to attract as a result of delivering good returns. So at the end of the day, it really is about delivering great returns and avoiding any greenwashing or things like that. So some funds might be more successful in their fundraise engines, but maybe they're not as impactful. And of course, those would be tainting the well a little bit as well. But at the end of the day, if a fund is generating proper impact, demonstrable, measurable, reportable kind of impact with good detail, and getting good proper profit growth and exits and returning capital to investors, that's ultimately the success that we need. And where I see the biggest opportunity, where we see the big opportunities is, as I mentioned, India as another example. It's already the third largest carbon emitter in the planet. So any climate-related investment you can make in India will have a significant climate impact for the species as a whole. As I sometimes say, Amber, the ice caps don't really care, where the warming is coming from. They will melt no matter what. So you might do a ton of decarbonization in Western Europe and North America, but if you don't have a strategy for the Indian growth that's coming up, then we're all, impacted in a similar way as a species. So I like to take a step back sometimes, think about it that way. So we are really excited about some of the themes that we mentioned, rooftop solar or solar, renewable energy that's significantly cheaper. Again, the green discount, significantly cheaper than the, fossil fuel energy sources. That's super exciting as an investment opportunity. Mobility, vehicles, two-wheeler, three-wheelers, when you see the tailpipe emission reduction potential there, as we chatted about with Battery Smart, these are, significantly exciting investment opportunities. Maybe just to give an example from adaptation, it is all getting warmer. No matter what we do, it's getting warmer, and therefore, farmers in Africa, farmers in India, are experiencing lower yields from the same seeds that they've been planting and the same soil and everything. So, drought-resistant seeds, for instance, is a really exciting investment opportunity potentially, and anything to do with, improving the yields of farmers, whether it's a type of pesticide or something else. Again, these are adaptation examples I also wanted to give in addition to mitigation examples.
Right.
And at Leapfrog, we also approach this in a very research-minded way. Maybe as a final comment, we put all of our research on our website. When we publish them, we publish the research on the overall excitement of the investment opportunity in Asia and Africa. We publish the research on Asia EV specifically, and so on and so forth. So we try to make an effort in saying, this is what we're excited about, and putting it all out there for the benefit of everyone.
Okay, wonderful. So thank you, Alan, for sharing such a clear and grounded perspective on the role of private equity in climate investing. Today's conversation highlights that solving climate challenges is not just about innovation or policy, but about how capital is structured, deployed, and scaled in the region that need it most. Emerging markets represent both the greatest risk and the greatest opportunity for climate action. Private equity has the potential to play a transformative role, but only if we navigate the complexity while delivering both impact and return. To our listeners, thank you for joining the Climate Leadership Podcast. We will be back soon with another climate conversation. Until next time, take care and have a nice day. Bye-bye.
Thank you.
Thank you, Alan.